Today we're diving into 10 investing mistakes, covering topics from expenses and market timing to index funds and taxes. Whether you're just starting out or looking to refine your approach, I hope you will find these insights helpful when you navigate the complexities of the market. Let's get started. Investing mistake 1: ignoring high-interest debt. Firstly, it's crucial to address high-interest debt before fully diving into investing. Credit cards today charge between 20 to 30%. This can seriously hamper your financial progress, especially when the interest charge compounds. Bear in mind that the returns on paying off your debt are guaranteed, while the returns on your investment are not. By paying off debt with a 30% interest rate, you are trading the certainty of freeing up money and improving your financial health for the potential for average investment returns of 10%. What if I told you there's a way to do both? Well, you can, using 0% balance transfer credit cards. This allows you to continue investing without the burden of high interest. You can split your payments between the minimum monthly credit card payment and your investment contributions. At the end of the 0% interest period, transfer the balance to another 0% card and continue this cycle while maintaining your investment contributions. However, ensure you make all minimum card payments on time to avoid damaging your credit score, which could make it harder to qualify for future 0% balance transfer cards, jeopardizing this entire strategy. Investing mistake 2: not preparing for a rainy day. Unexpected bills, car trouble, or losing your job can wreak havoc on your finances and your sanity. That's why having an emergency fund, a safety net of 3 to 6 months' living expenses, is so crucial. It provides peace of mind, knowing you can weather unexpected storms without derailing your life. Keep this in a separate, dedicated bank account so that you won't accidentally dip into it for day-to-day expenses, and automate regular contributions to this account. Here's a strategy to handle unexpected expenses while also investing for your future. Once you've reached about half your emergency fund target, say 2 to 3 months worth of expenses, consider splitting your contributions between your emergency fund and investments. This approach helps you build a financial safety net while also growing your wealth at the same time. Why choose one when you can do both? When you reach your emergency fund target, allocate the full monthly contributions to your investments and put all your money to work. Investing mistake 3: timing the market. Trying to time the market is one of the most common investment pitfalls. As the saying goes, time in the market beats timing the market. You could well be the world's best market timer, beating the likes of Warren Buffett and Peter Lynch. Until you aren't. The longer you stay invested, the more your money can benefit from compound interest. If you have a windfall, like a bonus or an inheritance, consider investing a portion of this as a lump sum, which Vanguard's research has shown to outperform dollar cost averaging about 68% of the time. Nick Majuli, who runs the Excellent of Dollars and Data blog, also found lump sum outperforming dollar cost averaging, even in shorter 24-month periods, using historical data. As Peter Lynch famously said, far more money has been lost by investors trying to anticipate corrections than lost in corrections themselves. The real risk is not keeping your money invested and working for you. Fear of market crashes can paralyze some, but history shows that bull markets have outlasted bear markets. Keep investing, stick to your plan, and don't let fear dictate your actions. The sooner you start investing, the better off you'll likely be in the long run, thanks to the power of compound interest. And every year you delay investing can mean missing out on a significant chunk of compound growth. Investing mistake 4: panic selling. Now, let's address a critical mistake some investors make: panic selling during market downturns. Legendary investor Warren Buffett once said, "Some people should not own stocks at all, because they just get too upset with price fluctuations." Panic selling, for fear of further losses, not only locks in your losses, but also guarantees that you will miss out on gains during market recoveries, which ironically compounds your losses further. This is a classic response for people with loss aversion. It's the tendency for investors to feel losses more acutely than the satisfaction from gains, and is one of the primary drivers for investment losses in down markets. Sticking to your investment plan, especially during market volatility, is key. Some find it helpful not checking their portfolio in such periods. This discipline helps you weather the downturns and benefit from the upswings. On the other hand, avoid the temptation to time the market, by attempting to sell at what you think is the peak, wait for it to hit rock bottom, and then buy low. You might end up selling when prices are low, missing the subsequent rebound, and then needing to reinvest at higher prices to get back into the market. No one can predict the bottom of a market downturn, not even the investing greats. Instead, focus on your plan, and stay invested for the long term. Investing mistake 5, following the herd. One common investor mistake is impulsive buying, driven by the herd mentality and the fear of missing out during market highs, or the FOMO syndrome. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." It's crucial to remember that chasing FOMO can lead to buying at inflated prices, potentially resulting in diminishing returns or even losses, especially after a strong market run-up. The key is to avoid emotional decisions. Instead, focus on the long-term perspective. Define a strategic portfolio using low-cost index funds that fits your investment goals and risk profile, and then be patient. This helps avoid emotional decisions and keeps you focused on your goals. We're halfway through our list of investing mistakes. So far, we've looked at mistakes related to expenses and temperament. Now, let's tackle portfolio management and taxes. If you're finding these insights helpful, hit the like button and subscribe for future content. If you have any questions, please drop them in the comments below. Let's continue. Investing mistake 6, not automating your investments. Life gets busy, and sometimes investing falls by the wayside. Manual trades can be tempting, but they can also lead to emotional decisions, or simply forgetting to invest altogether. This is why automating your investments is crucial. By setting up automatic monthly contributions into your investment accounts, you take the emotion out of the equation and ensure consistent contributions. To quote Warren Buffett, "The most important quality for an investor is temperament, not intellect." For investors with a workplace pension, review your default investments, as many tend to underperform simple global index funds. However, if your workplace pension has limited investment options, consider opening a separate SIP for additional flexibility. Regardless of the investment accounts you hold, always automate. Just set it and forget it. Investing mistake 7, complexifying your portfolio. Building a strong portfolio can be surprisingly simple. And simple is good. The late Charlie Munger noted that simplicity has a way of improving performance, through enabling us to better understand what we are doing. The Boglehead's philosophy is all about keeping things simple. Focus on a few, well-diversified index funds that spread your risk across different markets. Not sure where to start? Consider a fund of funds, like Vanguard Life Strategy or HSBC Global Strategy Funds, which provide a range of one-fund portfolios with different mixes of equities and bonds, depending on your risk profile. For those beginning their investment journey, these all-in-one funds handle the diversification and rebalancing for you. For those who want a little more control, consider a 2-fund or 3-fund portfolio that Bogleheads favor. These allow a bit more customization but still prioritize simplicity. You can always add specialized satellite funds later, when you're more comfortable, to gain exposure to, say, small caps, technology or emerging markets. Frequent portfolio changes can hurt your returns. Analysis from Vanguard and Morningstar over trailing periods from short to long time frames clearly favor a strategic portfolio over a tactical one. Once you've chosen a strategic portfolio that reflects your investment goals and risk tolerance, stick to it. You might need to adjust your portfolio for major life events like nearing retirement, typically 3 to 5 years out. But the bottom line is, investing doesn't require a complex strategy, a fancy financial advisor, or 50 funds. Start simple, keep it simple, sit back, and watch your wealth grow over time. Investing mistake 8, failing to diversify. Diversification is crucial for mitigating concentration risk. Concentrating your portfolio heavily on a handful of individual stocks, regions or themes increases your exposure to significant risk and volatility. This can potentially harm your overall portfolio performance. As Jack Bogle famously said, "Don't look for the needle in the haystack. Just buy the haystack." In short, buy the market. By spreading investments across different markets, you can protect yourself against unexpected developments. Even if you're wrong about the future of a particular company, country or sector, a broadly diversified portfolio across equities and bonds helps spread risk and offers opportunities for growth across different markets. Since you're invested in the overall market, you don't have to worry about missing out on emerging winners or sectors. You're covered. Excellent examples of broadly diversified funds include the Vanguard Global All-Cap Index Fund for equities, along with the Vanguard Global Bond Index and Global Short-Term Bond Index Funds for fixed income. Investing mistake 9. Paying too much fees. Picking winning stocks is a tough game. As Warren Buffett once said, the only value of stock forecasters is to make fortune tellers look good. For these reasons, passive index funds are a popular choice for investors seeking a simpler, lower-cost approach to investing in the stock market. The SPIVA reports, that compare S&P indices versus active funds, have consistently shown that passive index funds tend to outperform actively managed funds over the long term. The longer your investment horizon, the greater the potential advantage of index funds over actively managed funds. Whether you are in the accumulation phase in your 20s, or the decumulation phase in your 70s, beating 90 to 95% of active funds is not bad going. Index funds automatically rebalance its composition, by adjusting the holdings as companies grow or shrink. A notable recent case is Supermicro, which entered the S&P 500 in March 2024, with its share price soaring over 20 times in just 2 years, surpassing even Nvidia. This means you capture the winners naturally by buying the market, without the need to constantly tinker with your portfolio, or chase a new trend, sector or stock. Another advantage is lower fees compared to actively managed funds, which can accumulate over time. Actively managed funds charge higher fees, on the promise of outperformance, but as we've seen, most underperform index funds. Investing mistake 10. Forgetting tax allowances. When it comes to maximizing your long-term returns, prioritizing tax-efficient investment accounts is crucial. In the UK, this means maximizing contributions to pensions before ISAs, and ISAs before general investment accounts. Pension contributions receive tax relief, essentially a government bonus on your savings. Over time, this puts pensions way ahead of ISAs when building your retirement pot. Plus, the £60,000 annual pension allowance is higher than the £20,000 annual allowance for ISA, and your pension avoids inheritance tax if you pass away before 75. While you don't get upfront tax relief with ISAs, all withdrawals are tax-free and can be accessed anytime. This flexibility is ideal for those who might need access to their savings earlier than the normal minimum pension age, currently 55, rising to 57 from April 2028. An important consideration for those planning to retire earlier than 55. So, how can you make all this work for you? First, maximize your pension contributions by utilizing the full £60,000 annual allowance, where possible, and any unused allowance from the past 3 tax years. Workplace pensions often make this convenient with pre-tax deductions. If you don't have a workplace pension, consider investing in a SIP, using your take-home pay. Contributions receive 20% tax relief automatically, but higher-rate taxpayers will need to file a tax return to claim additional tax relief. Second, max out your £20,000 annual ISA allowance. Unlike pensions, the ISA allowance is limited to the current financial year, and cannot be carried forward. Use it or lose it. There's a case to be made for contributing to both your pension and ISA, to hedge your bets. This helps maximize your long-term savings while providing flexible access. Third, allocate any remaining funds, after maxing out your pension and ISA, to a general investment account. Finally, employ the BED and ISA method annually, to transfer up to £20,000 of existing investments from your general investment account to your ISA account. This maximizes your ISA allowance and keeps your savings tax efficient. Doing this annually can also help minimize capital gains tax liability, ideally before you exceed the capital gains tax threshold. And that wraps up our concise overview of 10 investing mistakes to avoid, along with the strategies you should employ to build long-term wealth. We have barely scratched the surface, so let me know in the comments if there's anything you'd like me to cover in a future video. Remember, successful investing is about simplicity, consistency, discipline, and compounding, so stay focused and patient. If you are still here, thank you for your time, and I hope you found this helpful. Don't forget to like, share, and subscribe for more content. Thanks for watching, and I'll see you in the next one.